Hey fools, I'm Taylor Muckerman.
And I'm Joel South. Today we're going to talk about big oil and potential problems in the space.
Now we're going to talk about EOG and its importance in Eagle Ford.
And also, the big story today we're going to talk about is the future of coal. We're starting to see maybe some good numbers. We saw some international numbers coming out of Europe and China. So why don't you get into it and tell us what's going on?
And for a little while there, people were worried about growth in China slowing down as it has dropped down below 10% growth in GDP. But you did see some good manufacturing data come out of China this week and some good factory data coming from Europe. So maybe some growth here out of the recessionary period that you've seen across the pond. And that's definitely great for coal because these are the two export markets that producers here in the United States have really honed in on.
So when you talk about this, what does this really mean for the coal sector overall? What does this data really relate to?
Well, the exports have really grown in importance thanks to natural gas and its effect on coal use here in the United States. You saw it drop pretty significantly last year as a percentage of total production of energy. It's kind of climbed back here in 2013, but it's still below historical norms. You saw CSX in its last quarter said that its coal volume transportation for export purposes was down 23%. So you have seen coal exports decline a little bit, and I think that maybe some of this news will lead to a nice boost over the coming few months, maybe close out the year on a high note, roll right into 2014. You look at Alpha Natural Resources, the largest met coal exporter, sees the market still oversupplied, so there might be some pricing pressure, but maybe the volumes will pick up there a little bit on the shipping side. And you look at Peabody, I think it's in the great position because it's got the cheapest coal coming out of the Powder River Basin as Australian assets close to China. And it's also working with Chinese coal companies, which could be beneficial because it kind of eliminates some of the transportation costs. If they can develop some joint ventures in country, they'll be able to reap some benefits from that. And then you look at CNX, best positioned to transport coal to Europe. They have their own wholly owned transportation facility or export facility off the East Coast, the only company that can claim that. You look at Alpha Natural Resources shares ownership over the facility that they use. So Consol, if they start pulling back on the coal exportation, because they really haven't been putting capital expenditures into that, they can probably use some of that export capacity for some companies that don't have the availability to reach Europe.
So do you think that this international data is just going to be a short-term blip, or do you think this could be a long-term tailwind for the industry overall?
Personally, I think it's just a temporary boost to the stocks. You've seen China plans to cut its 2010 coal use in half by 2015. So that's only a couple more years. I'm not sure about the progress on that, but I can imagine that they're really moving forward pretty heavily. If it's not 2015, it's only going to be a couple of years after that. And then the European Union really focusing on renewable energy, and I think that could possibly cut back on their coal use a little bit. So long term, I'm talking 10, 15 years, I don't see this data and China's resurgence really affecting coal companies very positively. You look at Consol, they kind of realize that moving into coal methane gas and Marcellus shale gas. So they're kind of pulling back on that a little bit. On the Pacific Northwest terminals that would really be a big boost for exports to China are still in doubt, very questionable. Some of them are even just being pulled off the table. So I look at that being the best way to export to Asia, but it's a huge question mark right now. So I don't think that this is going to be a long-term boost, and I think that U.S. coal companies should definitely be worried. And another worry that we've seen in the energy space is big oil. You've seen some problems here, Joel, and you want to kind of talk to us a little bit about that.
Yeah, definitely. You usually look in this space and see the bellwethers and are pretty safe to invest in them because they've had such great growth and they've had so many assets. However, if you look at the last few quarters, these companies have continued to go out and kind of release pretty negative information or numbers that were coming out. They were missing their analyst expectations. And then if you just look at the amount of money that big oil is spending, it is getting to that point where it's starting to get worrisome because you're seeing the reserve replacement ratios go down, more expensive locations that they're going to drill. And you can even look at a company like Chevron, which this year their cash flows from operations is about equal to what their capital expenditure will be. So, if you're looking at one of the bellwethers not actually spitting off free cash flow, that's pretty worrisome in this space. So, when you look at that, you have to start thinking, what is the better plays in this space? Can you still invest in big oil? And typically for investors that needed that energy part in their portfolio, they were pretty safe to go out there. So, when you're looking at, for the foreseeable futures, ExxonMobil spending upwards of $40 billion a year for capital expenditures, you're starting to see the big guys run into the issue where they can't really fund their growth that they're currently at and pay the big dividends and share buybacks, which they've been doing with the cash flow from operations. So now that they're actually approaching that level, you might have to see some of that dividend increases slow down, the share buybacks slow down, or actually have to stop going out and spending at such a large level. Typically, you've never had this worry with a lot of these big oils, but it is something that is now should be on investors' radar.
Yeah, the changing dynamics have really removed some of the wiggle room that these companies have witnessed, but they're still spending this increased amount of money, so somebody is providing a service for them in order to garner this wages. But who are you looking for to take advantage of this increased spending?
Yeah, definitely. I mean, if you look at service companies in general, they're the ones that are receiving a lot of this money. The one company that I really like is Core Laboratories, and this is a business that goes out there, works with big oil and a lot of independent oil and gas companies, and basically they go out there, do a number of studies, manage a lot of the wells, and actually will tell them exactly what they should do to increase yields. And when you're looking at wells that are so expensive to drill, especially offshore, some of these increases, even a percent or two yield increase is huge. I mean, you're talking about millions of barrels of oil. So this is a company that is in high demand. And if you look at what they're doing, they're very capital focused, and they're only doing getting into projects where they don't have a whole lot of margin pressures, which is fantastic for this business. And if you look at what they're doing for shareholders, this is a company that 23 cents this last quarter, 23 cents out of every dollar of revenue was free cash flow. So they're just keep returning free cash flow, which is just fantastic. And then also, if you look at what their makeup is, it's not a capital intensive industry. So what that means is, during the market troughs when oil prices are going down, and typically you'll see the capital intensive companies like all the drillers and Halliburton, Schlumberger's, the capital intensive services, you'll see them have margin pressures because they're losing a lot of business. This company, they only about 3%, they only have a depreciation factor of about 3%. So basically they'll lay off some workers, but you won't see that margin pressure. So this is a company that is in high demand, is turning a lot of free cash flow to shareholders, and when the market trough hits, you really won't see them affected that bad. So that's obviously very solid, and one reason I really like this company. Next, you wanted to talk about a huge play that 5-6 years ago was just a blip on the United States oil map. The Eagle Ford is now really progressing at a huge rate. Tell us more about this play.
Yeah, this is a area that you've even seen Core Laboratories talk about very highly. You look at the Eagle Ford, helping the state of Texas become the #1 producer of oil in the United States. And if you called it a country, it'd be the 15th ranked country as far as oil production in the world. And Eagle Ford is a lot of reason with that. You look at daily production up 60% year over year in June, slight decline over May, but I still see this as a huge positive. Companies here are just pouring a lot of money into the area. Return rates are very solid, and with shale fracking continuing to move into this region, you're going to continue to see a boost in production. You look at June's production of 621,000 barrels per day, equals 8% of the United States total production at 7.6 million barrels per day. So I foresee this really becoming more and more important, and you see companies now that haven't been operating here for quite a while returning because they see the promise.
Yeah, definitely. When you see a play that just grows at such a high pace, especially over the last 5 years, basically went to nothing to such a dominant position. What has made this really happen? What's behind this huge growth?
Well, fracking has really unleashed a lot of the oil that presumably wasn't attainable, and now you see many of the fields that were thought to be on the decline until fracking's use, they're now returning to production growth actually. So a lot of companies realizing that it's on pace to issue 10% more permits in 2013 than it did in 2012. So like I said, more companies coming back, applying for these permits, and I think that they will definitely be applied and approved by the state of Texas because it's just such a huge boom for the economy. You've just seen a tidal wave of resurgence in the economic activity down in Texas, largely because of fields just like Eagle Ford.
That's very interesting. And when we look at it as investors, what do you really hone in here? What is the big takeaway of all this growth?
I'm looking at the largest, most successful producers, and right off the bat, EOG Resources has 12 years of drilling resources still here in the Eagle Ford, and that's without any more further technological improvements to increase that replacement ratio. So I'm looking at 12 years of drilling here that they still have to operate on. They've been lowering their costs. You look at cut costs of well in the latest quarter from $6 million to $5.5 million. And they're also selling oil at higher dollar value than peers. It's slightly below Brent, but because of their access to the Gulf of Mexico, and they also have been using rail in the Bakken. So as a company, they've been able to access a higher price point than a lot of their domestic peers. And then I'm also looking at Apache, who's been focusing more and more on U.S. plays as they've realized that internationally they had tried to make that their cash cow, but they're slowly trying to transfer back to the United States, let the land assets that they have here really generate the cash so that they can go out and try and grow if they decide to. They're still divesting assets, but they're coming back to the Eagle Ford after 2 years since last drilling here. So they obviously see the potential, and I think that this is going to be a huge success story for Apache as they continue on. And then moving on to a story that you've been following, follows along with fracking, but it's kind of the dark side of fracking.
Yeah, definitely. EOG Resources is a company that's kind of under attack now, and the reason this is in Tripolo County, Wisconsin, which is basically the capital for sand mining. Basically, they're putting a 1-year moratorium on new permits. They're basically looking around, seeing that the silica levels and diesel fumes are really affecting a lot of this area. So this is a big worry for this company because EOG has used this as a great resource to lower costs in their fracking process. Yep. They've been very innovative in a number of ways, either through that or finding routes through rail to move their oil to higher markets. So they've been very, very successful doing that. So this could be, over the long term, a little bit of a headwind if they can't go out and get more of their fracking materials, especially with so many more wells and locations to drill. Another company that could be affected is U.S. Silica. They have a number of sand mines in this area as well. So we'll see if this 1-year moratorium actually holds up, or if this is just something that a few years down the line nobody will really know. But it's just one more issue or one more area that environmental concerns are really coming out about fracking. A lot of that was originally, looking at methane levels and a lot of water reservoirs. And recently, the National Academy of Sciences had a report that's saying that some of the methane levels, increased methane levels around some of these drilling fracking facilities in Pennsylvania were actually a little bit higher, or they were higher, but they were actually not from organic growth. Right. So it's actually something caused by pressure, like fracking thousands of feet below the reservoir. So that is worrisome. So this is something that you should look for going forward. There's going to be continuing environmental concerns in this area. So it is something that fracking, oil and gas fracking, and horizontal drillers will have to really focus on.
Certainly, yeah, it's tough.
So the next area you were looking at is Bank of America basically came out with a number of upgrades and downgrades. So why don't you really tell us what they're looking at?
Yeah, well, I usually don't put too much emphasis on these, but you see them in at least 3 different ratings changes today, 2 upgrades and 1 downgrade, and they all 3 had to deal with the pipeline industry. So you look at One Oak Partners, Williams Partners being upgraded, and then TC Pipelines, basically a subsidiary of TransCanada, being downgraded. I don't think that all of them are created equal, which is why I do think that there were some divergence here. So looking at their reasoning did provide some insight as to where these 2 industries are headed.
Yeah, definitely. If you look at TC Pipelines, do you think this is a company that really got the sharp end of the stick?
Not necessarily, because they deal mostly with natural gas, and so you look at the other 2 companies have meaningful natural gas liquids business, and I think that's where the reason why they've got the upgrade, because natural gas liquids have been kind of middling in 2013 as far as prices are concerned, but Bank of America is calling a trough. You have seen kind of a flat line here, thankfully, in the middle of the year. So these 2 companies could definitely see some business come their way as maybe more production comes online. And you also look like natural gas liquids exports, if those catch on, and that's going to lead to an increased reason for producers to boost the natural gas liquids that they're coming out of the ground with. You see One Oak has significant infrastructure from Colorado out to the West Coast, and then they also have pipelines coming from the Marcellus right down to the Gulf Coast. And then Williams Partners are just littered all around the Utica and the Marcellus, so huge natural gas liquid basins. And then TCP Pipelines just didn't make the cut. They got downgraded.
Yeah, this is kind of interesting. If you look at a lot of Wall Street banks, basically they don't really have that long-term view. If they see some blimps in the short term, they'll go out and downgrade companies. So sometimes they make these calls and they're not correct, especially if you are a long-term investor. You can actually use some of these for your benefit. So with a lot of these calls, do they look, or do you think that Bank of America is correct on this?
Well, looking at TCP Pipelines, I just don't know enough about this company to know specifically why this company was downgraded, but I do think that the natural gas infrastructure industry has had some time to catch up. Natural gas liquids are still pretty new to these storage and fractionating companies, so I think that natural gas infrastructure is slowly catching up, and there might not be as much growth, so I can understand it. But this does seem like Williams Partners' natural gas liquid margins have found a trough, so they're hopefully are going to start operating at a higher level here, drop some more revenue down to the bottom line, and they have a few projects in the works, so I can see why that upgrade happened, and I do think that it's sufficient. And then if you look at One Oak Partners, I really like this company a lot. They have 84% of the revenues coming from natural gas liquids, so if prices do start to slowly climb for the propane, butane, and ethane, they're going to be a prime candidate to benefit. And they have, like I mentioned, they have the great Mid-Con infrastructure, and so I think that the upgrade here is even more likely to benefit shareholders than even Williams Partners upgrade is.
Excellent. Well, thank you for your insight, and be sure to tune back into Fool.com.